Today's video covers the so-called capital asset pricing model, or CAPM for short. The CAPM provides important insights into the valuation of securities. However, the CAPM is more than just a purely theoretical construct. It is also frequently used in practice. But what exactly is the CAPM? The CAPM illustrates the relationship between risk and return in capital market equilibrium and visualizes this relationship using the so-called security market line, SML. For returns, the CAPM captures the so-called expected value of returns. For risk, the CAPM captures the so-called beta factor as a measure of systematic risk, but more on that later. Let's take a look at the graphical representation of the CAPM. On the y-axis, the expected return is shown, and on the x-axis, we have beta. Beta measures risk in the CAPM. Specifically, beta indicates the degree of fluctuation of the considered security compared to the overall market, our benchmark, also known as the market portfolio. The beta value of the market portfolio is always 1. If a security has a beta value greater than 1, this means that the return of the security fluctuates more than the return of the market portfolio. Conversely, a beta value less than 1 indicates that the return of the security moves less than the return of the market portfolio. It is important to note, however, that the beta value only captures systematic risk. Systematic risk is the type of risk that applies to all securities equally and cannot be minimized through diversification, meaning by adding additional securities. Examples of this include events such as economic crises or wars, which affect all securities. Unsystematic risk, on the other hand, is company-specific risk. Portfolio theory has already shown that this type of risk can be diversified away, for example, by covering various and ideally negatively correlated, that is, opposing, industries. If the prices of one industry fall, the prices of securities in another industry rise, and these opposing movements balance each other out. Since there is thus a possibility to offset unsystematic risk, taking on unsystematic risk does not yield additional compensation. Therefore, the CAPM only accounts for systematic risk in the form of the beta factor. Back to the CAPM, the so-called security market line, SML, which captures the linear relationship between return and risk, originates at the expected value of the risk-free interest rate. In theory, the risk-free rate is the interest rate that can be earned, for example, via government bonds with the best credit rating. Here, the beta value, and thus the risk, is of course 0, which explains the term risk-free. Starting from this point, the security market line increases linearly according to the principle. The higher the return, the higher the risk. In market equilibrium, all securities lie on this line. Even if individual securities temporarily move away from the SML, this equilibrium is restored according to the CAPM. Let's examine this with the following cases. Stock 1 is above the security market line, while Stock 2 lies directly on the line. Stock 1 therefore has a higher expected return compared to Stock 2, even though both have the same beta value and thus the same risk. The logical consequence is that investors will naturally prefer Stock 1 over Stock 2. More money can be earned here for the same risk. Therefore, Stock 1 is undervalued. Investors flock to Stock 1, increasing its demand and consequently its price. As the price of Stock 1 rises, it no longer seems as undervalued because the return advantage directly affects the stock price. What is the effect of this price increase? According to the CAPM, Stock 1 moves back onto the security market line and equilibrium is restored. In the next case, Stock 3 lies below the security market line, while Stock 4 lies directly on the line. Stock 3, therefore, has a lower expected return at the same level of risk, beta value. According to the CAPM, Stock 3 is overvalued. As a result, investors will want to sell Stock 3 and rid themselves of the overvalued stock. Consequently, the price of Stock 3 falls, and it moves back onto the security market line, becoming fairly valued once again. To determine whether a stock is actually overvalued or undervalued, we need to ask what expected return the CAPM predicts for the stock in order for it to lie on the security market line. For this, we can use the following formula to calculate the expected return according to the CAPM. The formula is expected return, CAPM, equals RF, the risk-free interest rate, plus beta times, expected return of the market minus risk-free interest rate. Let's look at an example. We are tasked with calculating the expected return according to the CAPM for a given stock. The risk-free rate is 1%, the market return is 12%, and the beta factor is 1.8. Using the formula, we get expected return, CAPM, equals 0.01 for the 1% risk-free rate, plus 1.8 for the beta factor times 0.12 for the market return, minus 0.01 for the risk-free rate. The return according to CAPM is therefore 20.8%. This value already provides important information about the expected return according to the CAPM. By comparing the actual achieved return with the expected return, we can further determine whether the stock performed worse, the same, or better than expected. Using the CAPM, we can quickly make statements about the theoretically expected return. Additionally, the model explains the fundamental market mechanisms for valuing securities. We hope this video has helped you understand the topic of CAPM. See you next time and have a good one.